Do you want to win with your money? I see people struggling every single day. And do you know why? Well, for the most part, it's because they don't understand how their money works. The fact is, you cannot improve anything that you're not aware of. That's why I made this series, Understanding Your Money, to help you have a better grasp of the most important financial concepts that you need to understand in order to be successful with your money. Now, I created 30 bite-sized videos teaching you everything you need so you can make the best financial decisions in your life for you. Now, without financial freedom, there is no freedom at all. So make sure that you subscribe so you don't miss any of the videos in this series. Also, if you find value in this, please share this video out and this playlist out because of the fact that I know it's gonna help so many people. As we're entering this recession that's coming right now, actually, I would argue we're already in it. This information is more important than ever, so let's do this. Hey, what's going on, cash flow hackers? Welcome back to the Understanding Your Money series, and today we're gonna be talking about one of my favorite things, and that is talking about what type of life insurance should you buy. Now, before I get into what type, let's just talk about why you need life insurance or why you want life insurance. So I want to be abundantly clear about my philosophies on this so you can understand why I am going to give you the information that I'm going to give you. Is that I don't believe life insurance is a need-based product. Think about it this way. I'm going to use my example. I've got a wife. I've got an 11-year-old, an 8-year-old, and a 4-year-old. My wife works. She does her own thing, and she's fine. Could she survive if I had something tragic happen to me? Probably. Hopefully, she'd get through all the mourning and the crazy sadness that she'd experience if something happened to me. Maybe she never would. Hopefully she would. But I have 3 kids, and I have goals and objectives that I want those 3 kids to live. The one thing that I do know, or believe at least, unless something crazy happened for my wife in a good way, is that if something did happen to me, the life that I'm trying to create for my wife and my 3 kids would probably never be actualized. It would never be realized by them due to my unfortunate, tragic circumstance, right? And so when I talk about life insurance being a want-based product, it's not about what I need to happen, it's about what I want to happen, right? And so that's why I have a big problem with people that say, hey, you need 10 times your income for coverage. Why? Like, why do I need that? Like, from a core values perspective, my question is, why do I need that, right? Like, why is it important, right? And then when you come at this from a core values perspective, if it really is for my wife and my kids to live the life that I'm trying to create for them, what is 10 times my income going to do for them, right? Probably not enough, quite frankly. And so what you need to be able to do is figure out, what do you want to happen? And then you utilize some of the other rules that we've talked about, some of the other concepts that I've talked about in this series that if you haven't seen, go back and watch a video on the Rule of 72, how inflation impacts your future, the 4% rule, these sorts of things that you need to understand to be able to make good financial decisions in your life. And so when we think about, okay, I know that I've got my kids that I want to make sure that I've got a fund set up for them to launch their career, to start real estate investing, to launch a business, to go through school if they decide that that's what they want to do, if they want to go to school to be an engineer, to be a lawyer, or to be a doctor, or do something like that. I want my money to be in an account where they can utilize it for whatever they want. Now, if they tell me, hey, daddy, I want to be an entrepreneur, I want to join your business or whatever, I got to tell you right now, they're not going to college because it's the biggest waste of money of all time. If those are the things that you're going to school for, right? You want to be an entrepreneur? Don't go give a school. Side note, don't go give a school teaching you that, with a professor that's never run a business successfully, which most university professors have not built anything of significance. Don't let them teach you how to build a business. Go find an entrepreneur who's built multiple successful 7-figure businesses. And if you got to, pay them to mentor you. And if you're falling into that category, you need access to people like that. I know plenty of wildly successful entrepreneurs I could connect you with that would be happy to mentor your kids through a program to be able to do that, right? Like that, to me, that makes a lot more sense. Now, if they want to be an engineer, a lawyer, a doctor, something like that, obviously that's where, to me, college makes sense. But the incomes are also correlated in higher value to offset the expense of college at the same time. And so that's kind of my rant there. But at the end of the day, whether it's college or real estate or entrepreneurism, and they want to launch a business, I want to have a fund sitting there. So what does that look like? How much money do I need? Well, at least $200,000 to $300,000 per kid, right? So that's like, let's just call it for my 3 kids. I need $1 million just for that. But then when we understand time value of money, that's $1 million in today's money. So now I got to go 8 years, 12 years and 14 years out for my 3 kids. So that million all of a sudden turns into like 1.5 million, right? And so that's just like where we are right now and what I want to accomplish for my kids. And so once again, this is not saying, hey, I want this or I need this. I don't need that. My kids need it if that's what I want to provide for them. And so it's really important, I think, to really understand why you're buying life insurance and really connect with the emotional side of why it's important to you. Because if you don't do that, it's always just going to feel like a kind of this horrible bill that you have to pay that's kind of catastrophic. And obviously most people think that nothing bad is going to happen to me. And until you have friends that pass away or have tragic situations happen to them, it's not real to you because you've never experienced it. But I promise you, I've seen it. I've experienced it myself. It's very real. And so I encourage you to think about that deeply. Now, getting into this, let's get into the teeth of this as far as what types of insurance should you buy. And I'm just going to move forward from this point forward. If you're watching this now and you're like, I don't really need insurance because I don't really want it, because I don't really care what happens to my wife or kids after, I'll pray for you. That's all I could say. But I really think if that's you, you probably just turn this video off and go to a different video. This isn't for you. But if you are aligning with, hey, you want to be able to provide the most, keep going. Let's get into what these products are. First one, term insurance. Okay, this is the product that a lot of people love. There's the whole buy term and invest the difference movement. Dave Ramsey loves term insurance, buy term and invest the rest, because they want to keep your insurance costs low. Now, term insurance, I got to tell you, I'm a big fan of term insurance because here's the deal. Most people, there's term insurance and there's cash value insurance. Most people can't afford the amount of coverage that they want. If you get here, right, you can't afford that amount of coverage immediately. And so you need term insurance to cover the gap, right, between whatever the cash value and the term is. Now, sometimes because of the unfortunate state of the economic environment that we live in and the fact that people are undersaved, people are in a lot of debt, a lot of times you got to get term coverage. That way you are protected and your family's protected, and you got to have that cheaper term coverage to be able to then accelerate and pay down your debt and kind of go from there. Maybe you don't have enough cash flow to kind of manage it all properly. Now, there are other ways to handle that as well, but that's another video. So term coverage, if the one thing that I want to say here, and this is really, really important to understand, if you go the term insurance route, there's 2 different types of term that you can get. There's basically like the super cheap, super affordable term, which is going to be the cheapest of the cheap of the cheap, right? And for you, that's going to be different based on your age and your health rating and so on and so forth, right? There's also a type of insurance called convertible term insurance. Now, what convertible term insurance is saying is that you get a term policy for a term, meaning when you buy it for a term, let's say it's a 10-year term or a 15-year term or a 20-year term, that term insurance is going to expire at the end of that 10, 15, or 20-year term. It's like renting the policy. At the end of it, though, if you buy a convertible term policy, during that policy, it'll have a contractual right for you to convert that policy to a cash value policy, right? And when you convert it to a cash value policy, like if it's a 10-year term policy, it's typically, there's going to be convertible provisions saying you can convert it for the full 10 years of the policy or up to age 65. So if you bought it when you were 58 and it's a 10-year term, it's convertible until you're 65. So you want to make sure that you convert it before that time. If it's a 15-year policy, typically they'll only let you convert it for like up to 13 years or up to the age 65 or 70 sometimes. And same with a 20-year policy, it won't let you convert it for the whole period typically, but they'll let you convert it for like 13 to 15 or 16 or 17 years of that 20-year term up to the age of 65 or 70. So those are just things to kind of consider when looking into that. Now, term, once again, great starter thing as you're trying to increase your financial efficiency, as we've talked a lot about. Pay down your debt, regain control of your financial life, make sure you have the protection in place. And once you get your cash flow into a place where you can afford more, then you start to convert. Now, the good part about converting is that you can convert in bite-sized chunks. You can take 10% of the policy every year and convert it in smaller amounts to cash value. Now, let's get into what is cash value life insurance. Cash value life insurance is life insurance that has a death benefit that goes along with it. Obviously, it's life insurance, but there's also cash value that builds up inside of the policy. And this cash is liquid. It's accessible to you. Now, it works differently on different types of cash value policies, and I want to make sure that you understand what the different types of policies are. So we have whole life insurance. Now, if you watch my channel, you understand I'm a huge believer in whole life insurance. I've done videos talking about the need of having an emergency fund, the need of having an opportunity fund, and a lot of people misunderstand and they think life insurance is an investment, or they sell it or have been sold whole life insurance as being some investment, or even universal life, IUL, VUL, GUL, thinking that there's some investment component to it. It's not that way at all. Life insurance companies do not invest. They simply preserve the purchasing power of your money, right? Now, what does that mean? That simply means they're going to keep the value of your money. If you go back to the time value of money, how inflation impacts our money, what our need for money in the future is, that's what I'm talking about. They're not going to take your $100,000 of cash and turn it into massive returns, but they'll probably get you 4% over a long period of time, which is going to preserve the purchasing power of your money. And so that 100,000, they may grow up to $250,000 for you, but it's not really going to be worth $250,000 in today's dollars. It's just going to keep that purchasing power, and you're going to have liquidity, use, and control of that money for emergency, for opportunity, and that's going to ultimately help you operate from a more financially efficient perspective. And when you understand all the other concepts that we've talked about to this point in time in this series, now it starts to make sense, the value and power of saving and before you invest. And when you understand that you need to save before you invest, a whole life insurance policy is the best foundational asset, bar none, to have as a foundational component to your personal finances of safe money. Now we got universal life insurance, okay? Universal life insurance was created in the early 80s. Since it came out, it still exists. Universal life insurance policies still exist. They're out there. You can get them. But there's also, they've spun off, actually, they spun off VUL first, and then GUL, and then IUL came after. Now, VUL is variable universal life, and for anybody to sell VUL, they need a securities license. They need at least a Series 6 license to sell it, because what they do is they take insurance and they put mutual funds inside it. So what happens is they have the universal life foundation chassis, if you will, and they wrap mutual funds. They kind of put the universal life chassis as the wrapper around the investments. And that's why, because the investments are in there, and there are different index or different fund options that you can typically do in the universal life insurance, the VUL, variable universal life product, you need to have your equities license to be able to do that, your Series 6 at least. Now, GUL is simply universal life with a guarantee on it. It's guaranteed universal life. And this is typically done for estate planning. And it's a good way to get permanent life insurance and keep it there on a guaranteed basis if you're worried about not being able to afford, or if you're worried about the term running out and you can't afford whole life insurance. Typically, you can get GUL at a cheaper monthly expense than whole life insurance. And if you're worried about having guaranteed insurance forever until, say, you're 100 years old, and you want to do it on a more affordable basis compared to whole life, GUL can be a great fit for that. Index universal life, I've done a lot of videos on this, and I'm not going to get deep into it in this video because out of my own fear of going down a tangent. But index universal life is simply universal life insurance participating in the index. That's what the I is for, the index. Now, what they're doing is they're taking a crediting strategy that came from the general fund of the life insurance company. They're buying an option strategy, call options, and then that call option will give you a return, or you'll lose it, and it's going to perform, how it performs. Honestly, it's the most missold product. That's what I will say. The most misrepresented product. The reason I say that is because you're not really taking the risk on. And if you understand how options work, they're sold as if options get you this huge upside, but options don't do that. Options are hedges, right? Now, can people make a lot of big returns in options? I think there's a lot of options traders that do really well because they take these crazy risks in options, and you can get like really big asymmetric returns inside of options trading, right? At the same time, that's not how life insurance companies use options. They use options as a hedging strategy. And at the end of the day, the general rule of thumb is that an index universal life policy is never going to outperform the general fund of the life insurance company. It can give you a little, like say 50 basis points of upside, but with that 50 basis points of upside compared to a traditional universal life, that's really all it is it's a little upside compared to a traditional universal life. You're taking on more risk, and that's important to understand. So at the end of the day, that is my summary of why I like whole life insurance. If you're going to go cash value life insurance, whole life insurance is the way to go. Here's what I want to tell you. There's a lot of bad information out there. There's a lot of people that have a lot of disdain for whole life insurance or permanent cash value life insurance as a whole. Here's what I will say. It's got to be properly designed. And it's got to have cash value. We'll call it. I don't want to use this term actually. So you want to do a good blend of good cash value, and it's got to have a blend of paid up additions, which is paid up permanent insurance, but it comes with a lot of liquidity, right? When you do this the right way, here's the general rule of thumb: whatever you put into a whole life contract, you should have between 80 and 90% liquid cash value year one. If you're paying $10,000 a year in premium, think about it this way: it's going to bang out your insurance needs, but like out of a $10,000 premium, it's going to get your insurance covered, but it's also going to give you, let's call it $9,000 of cash. Okay, and if you do it the right way, this $9,000 in cash will be your emergency fund. So this is what I always tell people. It's the only way to get your money to perform more than one function in your life, because now you're hitting your need for insurance, if in fact you've determined that you do need it based on your wants and your goals and your desires, right? So if you have that, so you have a $10,000 premium, but out of that, once again, I would say only 1,000 of it is really going to the insurance, because 9,000 of it is liquid. Now that might pick up, let's just say hypothetically, this gets you a $500,000 death benefit, right? And if you got that $500,000 death benefit, what happens? Okay, you have the $500,000 death benefit. Well, as the cash value grows, because of the paid up additions is how we're doing this, this 500,000 will grow to say 510,000 or so, right away. And so what happens is a lot of people say, oh, whole life is horrible because you don't keep your cash. As your cash value grows, the life insurance, you don't get the death benefit and the cash. Well, this is actually showing what you're really doing is you're starting with a $500,000 death benefit. By utilizing paid up additions, you got the cash growing in it, and you could see you're able to, they will keep the cash. If you were to die year one in this scenario, or year two in this scenario, when you put 9,000 in, you're not going to get the 9,000 and the death benefit, but the death benefit went up to 510. So you can see that, yeah, they keep the 9,000, but you get the 510 at this point in time, right? So you actually come out a little ahead in this scenario. Now, it doesn't always work that way. The longer it goes out, it works out to be a little more even than that, where, maybe 10 years in, I put in 100,000, and maybe the death benefit is right on the money at 600, right? So am I going to get the 600 and the 100? No, but they're going to keep the 100. I'm going to get the 600, but I originally bought 500 plus the 100 is the 600. Why do they do this? They do this because if I were to put this in a savings account, this 100,000 in a savings account, and I were to die and pass that to my kids, this is taxable. So they could pay this, they could separate the two, and give the $100,000 taxable and just pay out the $500,000 death benefit. The reason they do it this way is so they could pay all 600 of it in the tax-free nature to your heirs. Like, so what's hilarious to me is people like Dave Ramsey like to rip on the fact, oh, you don't get the cash and the death benefit. Well, okay, you can rail on that, or you can like actually understand what you're talking about and realize the benefits behind that, right? And why they do that, and why the tax-free nature of this exists and how everything works. And so, like, that's an important thing to understand. And so, what it really comes down to is, I think personally, is why I love what I do with this stuff so much, is that properly designed whole life insurance policy should be a cornerstone foundational asset for everybody at some point in time. If you are not in a place where you can afford it yet, get term, get it convertible term, convert it to whole life when you can. When you design it in a way so you have as much cash value as possible. Like I said, 80 to 90% cash value. You want to have that done. And as you do that, that's year one. By the time you hit year 5 and 6 and 7, it's going to actually not only outperform what your bank account would do for you, but you're going to have the outperformance of the bank account, plus you're going to have the cash value, whatever that would be, maybe 550,000 or probably 50,000 in cash value or so, right? Plus you're going to have the $550,000 death benefit, so it'll actually be 500,000 of life insurance on top of the 50, if you want to look at it that way, right? And plus you have living benefits. I'll just call it LBRs, living benefit riders. If you become chronic or terminally ill, if you become chronically or terminally ill, you have access to a portion of your death benefit while you're alive to help cover your medical directives, right? If you lose 2 of 6 daily functions or become cognitively impaired, that's chronic. If you're diagnosed with 12 or 24 months, depending on the carrier, or less to live, that's terminal. You can accelerate this death benefit to deal with cancer treatments, to deal with living facilities and in-home care and stuff of this nature. So in a world where a lot of people are having a hard time, we think about, once again, when I ask you, what are you looking to accomplish in your life? We have to realize that 70% of people are going to need some sort of long-term care or assisted living while they're alive. 70%. So when you take a married couple, I was just at a seminar this weekend, we're talking 91% chance you or your spouse are going to need some sort of living assistance. Think about that. That's astounding. And so we know beyond the shadow of a doubt that we need to plan for that, right? And so the great part about whole life insurance policy is that it's gonna be there. This is why I say whole life policy, when designed properly, is the only way to make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. Now let's go through the life cycle of why I believe this to be true. Because right now, what do you need? You need an emergency fund, bare minimum, right? You need life insurance, or you should want life insurance. If you're still watching this, you probably do, right? So in doing that, I need my emergency fund of $9,000 right here, right? So I've got this $9,000. I could start saving. I'm going to start depositing $10,000 a year into my life insurance policy. It's going to cover my life insurance. It's going to cover my emergency fund. That'll get better and better and better every year. And then as I go through life, that'll get better. Now, once I get the emergency fund checked off, now I can add in and keep doing it. And I have an opportunity fund, right? Now, if you've watched the other videos, you know what I'm talking about. I'm not going to get into huge detail in this video about what an opportunity fund is or why the importance of that is there, but just know it's there. So you could see the life cycle as we're going through this. We build the opportunity, we build the emergency, we've got the life insurance checked off. And now as we get later in life, as we need, while we're living still, as we get to the point where, okay, we're hitting retirement, we may run into situations where we need to use this. We become chronically or terminally ill and we need to access this. We know that we're going to be able to have access to, a portion of the death benefit while we're alive. It's going to cover our needs. It's going to protect us. It's going to give us our dignity. That's going to make it so we don't become a burden on our kids, right? Now, if for some way you were healthy enough and you were fortunate enough, blessed enough, and you made good enough decisions with your health as you went through life, you were able to go through retirement and not utilize it. Well, now you have cash, extra cash to be to utilize for retirement, right? It could be income for retirement. It could be a volatility buffer. I'll just write VB for volatility buffer, to make it so your other assets were able to perform better based on the sequence of returns and all these different things while you're in retirement. Because remember, while we're in retirement, you're going to hopefully be there for 30 plus years, right? If you're in retirement for 30 plus years, you know that you're going to be not earning money while you're in retirement, right? And so when markets go down and you're still pulling money out to live, this is when you need access to guaranteed money to let your other assets rebound, right? That is the power of what we're talking about here, right? So you know you have it to perform all these functions. And then if you get through, whether you pass away early, whether you live a long, healthy life, this death benefit is always there. Whatever's left after it meets all your living needs, the death benefit is going to be there. So anybody that says this whole buy term and invested difference is the way to go doesn't understand this full story, because there's zero chance that you can look at a fully optimized financial plan utilizing buy term and invested difference. Even if you do invest a difference, even if it all goes into mutual funds or other investments and you think you have enough money, there are other risks that come into play, other expenses that come into play that are not taken into consideration when you follow that methodology. So anyway, I hope that makes sense. If you have any questions at all, comment in the comment section below. I know there's a lot to this, but this is why I love this so much. This is why I think this is some of the most important stuff in the world, in the realm of personal finance, that people need to understand. I think when you do understand this, you understand it really is not a need-based, it's an emotional base. Like, what do you want to happen, right? And it really is about making sure that your kids and your family, your spouse are taken care of, and making sure that your dignity is intact for your entire life. Like, I don't think we can understate, or I don't think I can overstate the value of that, I guess is the way to put it. So anyway, comment in the comment section below if you have any questions. If you haven't already, make sure you subscribe to this, hit the bell, because I've got this whole series coming out. This is just one of 30 plus videos that we have coming out on this Understanding Your Money series, all the world of personal finance, so you can understand these topics in a way that hopefully will allow you and enable you to make a more educated decision based on what you and your what your objectives are in your life, and help you make the best, most educated decision so you can actually have empowerment to get there. So that's it. Till next video, have a blessed, inspirational day. We'll talk soon.